Non-residents of Canada are subject to Canadian tax on income they receive from Canadian sources. The amount of tax and the specific rules depend on the type of income and any applicable tax treaties between Canada and the non-resident's country of residence. Here are some key points. 1. Employment income. If a non-resident earns employment income for work performed in Canada, they are generally subject to Canadian income tax on this income. Canada applies progressive tax rates, and non-residents may also be entitled to certain deductions. Employers typically withhold tax from the income. 2. Business income. If a non-resident earns business income from carrying on a business in Canada, they must report and pay Canadian tax on that income. The non-resident must file a Canadian tax return and will be taxed at standard rates unless reduced by a tax treaty. 3. Rental income. Non-residents earning rental income from property in Canada must pay a 25% withholding tax on the gross rental income. However, they may elect to pay tax on their net rental income by filing a tax return under Section 116 of the Income Tax Act, which may result in a lower overall tax rate. 4. Investment income. Dividends. Non-residents are subject to a 25% withholding tax on dividends paid by Canadian companies. This rate may be reduced under a tax treaty. Interest. Interest income earned by non-residents from Canadian sources is often exempt from tax if it is paid by Canadian banks or other arm's-length sources. However, certain types of interest, for example, participating interest, may still be subject to withholding tax. Capital gains. Generally, non-residents are only taxed on capital gains from the sale of taxable Canadian property such as Canadian real estate or certain shares in Canadian companies. 5. Pensions and other retirement income. Non-residents may be subject to a 25% withholding tax on Canadian pension income, including withdrawals from RRSPs or RRIFs, although this rate may be reduced under a tax treaty. 6. Tax treaties. Canada has tax treaties with many countries to prevent double taxation and provide tax relief on certain types of income. These treaties can reduce withholding tax rates on dividends, interest, and pension income. It's important for non-residents to check the relevant treaty provisions with their home country to determine the exact tax obligations. Non-residents must file the appropriate tax returns or forms to ensure they meet their Canadian tax obligations depending on the type of income earned and treaty benefits they are eligible for. Please like and subscribe.